Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So at this point, I want to turn it back to Jack, and let's try to answer all your questions. Jack, you had a chance to look at all the questions. Did you see anything that really stuck out? Jack, question. I guess everybody likes this.
Oh, I'm sorry. I was on mute. Sorry about that, Steve.
It's okay.
One of the questions, I think that the first answer is why is the euro so strong against the U.S. dollar now if all this is supposedly going on, and markets do odd things, and we can never know. And at any point in time, we have to accept that the market price is right, has more information than us. But part of this process, as we said, started right around 2001. The euro, when it was introduced, went right down to 82 cents, and then the dollar really entered a major bear market. And we think it was an implicitly driven dollar bear market in order to use the dollar as dollar-based credit to fund a lot of the asset classes. If you remember, and it's hard to remember this now, but when the stock market broke in 2000, the NASDAQ broke, and we started seeing really massive final good prices, cheaper and cheaper coming out of India and China. The concern was a major global deflation, and that's why the central banks pushed rates so low at that point in time. So the goal basically was to push the dollar into a bear market, so we pushed dollar credit out there around the world, and I think it was very much engineered, and it worked very, very well because we had wealth going up on our stock market, we had wealth going up for the consumer in the housing market. All of this thing went together in kind of a symbiotic relationship. But I said during this time, you can paper over a lot of these structural problems that are developing. But when things start to turn is what, and Friedman made the point, when we start to see a real test, a real shock to the system, then we'll find out what the euro is really about. And I don't think the market really understands the depth of exposure still on the European banking balance sheets and the potentiality of one of these countries really leaving the system and the trigger being the emerging markets. So again, where would we be wrong on this? We would be wrong, I think, if two things. If we see a real rebound in global demand, this problem will probably be worked out, and that's really the key. But part of our story is we don't think we're going to see a cyclical rebound in global demand, and that's why we're very, very concerned about this. Currencies overshoot. They overshoot their values. And as I said, even if you forget about any of this going on in the background in the Eurozone monetary system, from a parity standpoint, purchasing power parity, the euro really overshot its fundamental values, which should be around 110 to 115 against the U.S. dollar. So we just think this potentially could be icing on the cake if a rebound in global demand does not materialize. And with rising unemployment rates in Europe, rising unemployment rates in the U.S., rising unemployment rates in China, we keep looking for the green shoots, and I guess we have brown colored glasses on or something. So we're very concerned. And also, again, we could be wrong on this, but the reality is, what is the risk-reward trade here? Using these FX options, the risk-reward trade is making a small bet on a longer-term option for a major event like this out of the blue, kind of the Black Swan event, I guess, but it's not really a Black Swan event because we've already defined some of the risk. But if we're wrong, we're going to lose a little bit. But if we're right, and the euro does implode, you're talking about a massive leverage move in an FX in one of these euro calls that Steve had talked about. So from that standpoint, it's a scenario with rising probability, and we have the ability to play it with limited risk, but upside basically unlimited. And that's the way we're looking at this. Again, making a small bet, but a small bet can turn very, very big if this plays out.
Jack, great question from Terry. And Terry says, so which currency should we buy then? Assuming, I guess, one would be the dollar. Would you put another in that safe status if the economy continues to worsen? Where else would you go?
Well, we're kind of oddballs on this. We actually believe the dollar will be, as the world reserve currency, will again be the major risk trade currency, meaning if we see an implosion like this, deep institutional money that is involved in Europe in a very, very big way will only have one place to hide, and that's in the U.S. Capital markets. So the dollar wins the game, again, not because of anything special or anything good going on inside the United States, but we have the deepest capital markets to hide here. Nobody else plays that role. We can't see any other place where the money would go other than possibly into gold. But we could envision a situation if we see deep portfolio money moving out of Europe. We can see both the dollar rallying because people buying the U.S. Treasuries, and we can see gold rallying because of a lot of money, possibly even from the Middle East, allocating into gold at the same time. So the dollar is our choice, and I know that sounds odd in this world, but it's not always about what's going on in the headlines. It's about capital flow, and the capital flow we think would move massively to hide in the U.S. Treasuries if this happened.
Interesting. Andrew has a point. Jack, isn't the reverse the truth, that the financial crisis strengthens the euro because it allows the pigs and their friends to externalize their costs in Germany? I think you actually brought that out. And I actually have a side question for you, Jack, because when you were mentioning that, I was thinking about it, and it all makes sense, but isn't it really dangerous considering what happened to Iceland and even Ireland? Like, let's say that one of the pigs decided to get out. Isn't that almost more dangerous than being in the mothership of the euro, or what do you think?
It is. It is, and that's part of what's keeping them in. If they were to leave, their funding costs would soar dramatically. So that is one of the reasons that's keeping them in. But that's one of the situations where we see the pressure growing on the euro. The other is as I said, it's a dual problem. The pigs themselves that are incredibly exposed, but it's also the emerging markets of Europe that crush the European banking system, and that creates all types of other externalities in terms of just meltdowns in the countries themselves that would flow directly into the euro from just a fundamental standpoint. So it's really twofold. But you are correct, and in fact, a lot of the countries are trying to move into the Europe during the crisis to try and provide some shield. But the European Union is actually pulling out the Stability Pact Treaty and saying, well, you can't get in because you don't meet X, Y, Z, overlooking the fact that some of its members already don't meet X, Y, Z. They don't want any more exposure. They don't want any more baggage inside the Eurozone to be attached to it. But you're right, it has become somewhat of a safety magnet. But think of it this way. As each of those basket case countries comes in and ties itself, it's more and more exposure for the entire system.
Very intriguing. Let me see. Patrick wants to know, he lives in Ireland, and he says, well, where should I go? And obviously, things are challenging there in Ireland, and if he believes that the euro is in trouble, so you think it's the dollar. You think that old European money would actually hide here in the U.S. for a while?
Yeah, I'm not saying all of it, but I think the U.S., we saw it during the credit crunch, and we'd see the same thing. On a major risk-averse move in the global economy, the dollar wins. The doom and gloomers, as I said before, got this credit crunch right. But what was their prescription? Sell the dollar. They got that very, very wrong. The dollar rocketed like 25% on the risk move. It just comes down to where else. The question is, where do you put the money? And so the answer is, where else to put the money other than the dollar? We just don't see any other natural hiding place here other than possibly the metals.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.